Welcome to The Explainer. Today, we're jumping into a topic that can feel like a real puzzle, money and banking. But don't worry, we're going to turn it into a game you can absolutely win.
So let me ask you, does money and banking ever feel like that final boss level on an exam? If you felt completely overwhelmed by this chapter, trust me, you are not alone. But that's all about to change. You see, the trick isn't to memorize endless paragraphs. The secret is that this whole topic is built on a really simple, predictable logic. We're basically going to give you the cheat codes. So let's dive in. Okay, level 1. First things first, we need to know what we're even talking about. Before we can get into how money is created or controlled, we have to figure out what actually counts as money. Here's the key idea. Money supply is a stock, not a flow. What does that mean? Well, think of it like taking a snapshot photo. It's the total amount of money held by everyone on one specific day, not a video of money moving around over a week or a month.
So, the most common way we measure money is with this formula, M1. It has 3 simple parts. C is just currency, the actual notes and coins people have. DD stands for demand deposits, which is the money in your savings or current accounts that you can take out anytime. And OD is other deposits, a really small part held with the country's central bank, the RBI.
And here is the single biggest trap you need to watch out for. We always include demand deposits in M1, but we never include time deposits like a fixed deposit. And why is that? Well, it's because you can't just demand that money back whenever you want without a penalty. It's just not liquid enough to be considered part of M1.
All right, let's move on to level 2. This is where things get really interesting. We're going to look at the most powerful and honestly kind of mind-blowing concept in this whole chapter, how banks literally create money out of thin air.
And believe it or not, it all comes down to this one super simple formula. The money multiplier is just 1 divided by the LRR, which stands for the legal reserve ratio. That's just the percentage of deposits that banks legally have to keep in reserve. They can't loan it out.
Check out how this works. Let's say someone deposits 1,000 rupees. The bank keeps 20%, or 200, as a reserve and loans out the other 800. Now that 800 gets spent and ends up being deposited in another bank. And what does that bank do? It keeps 20% of the 800 and lends out the rest. And this cycle just goes on and on.
So with that 20% reserve ratio, our money multiplier is 1 divided by 0.2, which is 5. And what that means is that single initial deposit of 1,000 rupees gets multiplied 5 times, creating a grand total of 5,000 in new deposits throughout the entire banking system. Amazing, right?
So now we know how money gets created. Let's talk about the game admin, the central bank. This is the institution with all the controls, the one that uses its tools to manage the entire system.
The logic behind every single tool the central bank uses is actually incredibly simple. To fight inflation, which is just too much money in the economy, you do things to make money harder to get. And to fight deflation or recession, you do the exact opposite. You make money easier to get.
And this cheat sheet shows that master rule in action. Look, to fight inflation, the central bank raises interest rates and reserve ratios, like the CRR and SLR. To fight deflation, it just lowers them. For that last one, open market operations or OMO, it's just as simple. It sells government securities to shrink the money supply and buys them back to grow it. Let's use an analogy for OMO because it makes it so much clearer. When the central bank wants to fight inflation, it sells securities. Think of it like dropping a dry sponge into a bowl of water. That sponge, the security, soaks up all the extra cash from the market, leaving less money available to lend. And to fight deflation, it just does the reverse. The central bank buys those securities back. This is like squeezing a full wet sponge over the bowl. It floods the market with cash, increasing liquidity and making it way easier for everyone to get loans.
Okay, so beyond just pulling those big levers to control the money supply, the central bank has a few other critical jobs you definitely need to know. Think of these as its day-to-day admin duties.
So here are its official titles. It's the only one that can issue currency. It literally prints the money. It acts as the government's personal banker. It's also the banker's bank, supervising all the other banks. And crucially, it's the lender of last resort, stepping in with emergency funds to prevent a crisis if a bank is in trouble.
All right, let's do a super quick recap of the whole system. Think of this as your final cheat sheet, the core logic of everything we've just talked about.
It really boils down to this. 1. You define what money is. That's our friend M1. 2. You get how it's created. That's the money multiplier effect. And 3, you know who's in charge, the central bank, using its tools to manage the economy. If you get these 3 points, you've totally mastered money and banking.
And remember, this isn't just theory for an exam. This is happening in the real world right now. So next time you see a news headline about the central bank raising interest rates to fight inflation, you'll know exactly what they're doing. Now that you've got the cheat codes, keep an eye out. See if you can spot these ideas in action.